If there was a perfect dividend ETF, what would it look like? Of course, it would start with a high dividend yield. Then you'd probably want some built-in risk management, and for an added bonus, at least a little bit of growth is always nice, right? I mean, I wouldn't complain.
Now I want all of it.
Welcome to Constant Cash Flow. I'm Jonathan, and today we're looking at NUSI, the nationwide risk-managed income ETF. Now, while no stock or ETF is perfect in the truest sense of the word, this one checks all the boxes and is definitely worth a closer look. According to its fund overview page, NUSI offers an innovative approach to traditional income investing by employing a dynamic, risk-managed net credit collar. Traditionally, an options collar involves selling a covered call option, which limits upside, while simultaneously purchasing a protective put option, which limits downside for a zero cash outlay. NUSI's objective to employ a net credit collar strategy, however, implies that they'll receive more income from selling call options than it costs them to buy the put options, which is how it achieves its high yield. NUSI's a relatively new fund, having been launched on December 19th of 2019 and has been fairly successful with just over $728 million in assets under management. It has a share price of $27.73 as of the making of this video, and has returned 1.75% when looking at share price alone over the last year. Total returns including dividends over that same 1 year was 10% and has returned just under 30% over the last 2 years since its inception, which isn't bad for what I call an income now fund. Now, before we jump into the dividend detail, I want to take just a few seconds to give a quick shout out to two recent subscribers, Cameron Herod and Robert Wheeler. Thanks for watching, subscribing, and the great feedback and comments.
Why are you guys so awesome?
Now let's get back to work. When looking at the dividend for NUSI, it definitely stands out, as it has a trailing 12-month dividend yield of 7.77%, and it pays out each and every month. Its last payout was 18 cents per share on December 27th of 2021. When evaluating a dividend ETF, one thing to always pay close attention to is its holdings and the distribution percentages of those holdings. When we look at NUSI, it's important to note that its top 10 holdings make up 52.6% of the total fund assets. Those holdings, of course, are very well-known NASDAQ stocks, including Apple, Microsoft, Amazon, Google, and Nvidia. And we'll come back to this later. The benchmark index listed on NUSI's fact sheet is a close representation of the fund's strategy, but that particular index buys and sells options based on the S&P 500, not the NASDAQ 100, and it does so for a net zero cost. In contrast, NUSI's net credit strategy means it purchases less downside protection than a zero-cost strategy offers. NUSI's outperformed this benchmark since its inception, mainly because the NASDAQ 100 has outperformed the S&P 500 Index ETF, SPY, during this time. Comparisons with other popular dividend ETFs like DIVO or JEPI have little value unless an assessment of the index's underlying assets is made. So let's take a closer look at that.
Yes, let's do that.
As I've stated in other videos, the quality of the underlying index matters most, even though the option strategy and yield is the appeal where cover-called ETFs are concerned. With NUSI, the index utilizes a NASDAQ 100, which is over 50% technology, followed by another 34%, pretty evenly split between communication services and consumer discretionary stocks. This concentration level may bother some investors and therefore could be good to hedge against. As we discussed before, the same is true for the top 10 holdings, which total 52.6% of the fund, according to Yahoo Finance. It's actually a little more concentrated than that since Alphabet has both share classes listed, but still, it's an issue that sounds like it would be a good candidate for hedging if we have reason to believe it's necessary. As an options-driven income strategy, the NUSI ETF has some important tax implications for investors as well. Normally, the cash-settled index options used by NUSI are taxed 60% at the long-term capital gains tax rate and 40% at the short-term capital gains tax rate. However, if NUSI distributes capital gains to investors, these could be taxed at short-term or long-term rates. So you could actually be getting a pretty diverse mix of dividend sources and tax treatments from NUSI distributions. But it turns out they've actually been distributing dividends made up almost entirely of return of capital. which made me dig a little deeper. What I found out was that distributions made up of return of capital have no immediate tax obligations. Instead, taxes on these dividends are deferred until you sell your shares.
That's what I'm talking about!
Return of capital can be a bad thing in some cases, but NUSI seems to be using it to their benefit and in return to the investors. With this strategy, investors have much more flexibility on when they pay taxes on their distributions. This can accelerate dividend reinvestment or provide more cash now compared to the standard capital gains taxation.
I'm so excited!
NUSI's 7.77% yield is excellent, but it's also about as high as one should go with options ETFs if you're looking for any income whatsoever. Anything more and you're likely giving up far too much upside, or you aren't receiving much downside protection. For me, NUSI represents a good short-term fix to a risky portfolio, as the data consistently shows how significant the underperformance can be in the long run. I don't feel like NUSI is perfect as a constant set-it-and-forget-it type of investment, but in certain situations, it is a great fund, especially if you're looking for more tech exposure with protection on the downside. I do believe that the NASDAQ 100 may need protection due to its constituent small quarterly revenue surprises in the last quarter. However, the index doesn't appear to be in serious trouble as some may assume. These are highly profitable and established companies that can weather most storms, and a fall of more than 5% per month isn't likely to happen often. More likely than not, QQQ will retreat in the 2.5% to 5% per month range, which is NUSI's sweet spot. Based on this, I do give NUSI a bullish rating for now. Let me know in the comments what you think about NUSI and if it has a place in a strong dividend portfolio in today's market. As always, please do your own research to see if any investment might be a good fit for you, your goals, and your personal risk tolerance. Thank you so much for watching until the end. Don't forget to like and subscribe if you've gotten any value from today's video. And if you're unsure on whether or not a dividend ETF is right for you, check out my video on the right that discusses dividend ETFs and decide for yourself. Once again, thanks for watching, and I can't wait to see you next time.